Welcome to Theo Trade. This is Don Kaufman. It's June 4th, 2018. Let's kick off this Theo evening video, inviting each and every one of you to theotrade.com/trading returns. This happens to be discovering high probability trading returns in all markets. This is actually going to be a session that we're going to do on Tuesday evening. Again, Tuesday evening, that is June 5th. 8 p.m. Eastern Standard Time. And in this session, we're going to talk about selling option premium really in the current market environment. It is going to be what we term delta neutral strategy. Specifically, we're going to be getting into a little bit about iron condors and selling iron condors over the duration. These are extraordinarily high probability trades, but at the same time, we're going to discover how not to take substantial losses against some of these high probability trades. With that, again, I invite you, the link to this session, theotrade.com/trading returns. See everybody tomorrow night. That is Tuesday, 8 p.m. Eastern Time. With that, let's get to the markets. Getting to the markets, the S&Ps have just closed moments ago, up 12, but the real story here happens to be none other than the NASDAQ. People once again taking off to the upside, and really in effect what we're getting right now happens to be kind of what I would call the tale of two completely different markets. Now let's focus on this for just a few minutes, and then we're going to talk about some of the specific positions that I've been kind of calling out and some positions that we're going to be calling out kind of moving forward. So as I was saying, like a tale of two different markets, the S&Ps, okay, versus the NASDAQ, but it really doesn't necessarily come down to the S&Ps versus NASDAQ. What's going on over here has a lot to do with financials versus specifically the monsters of tech. Now, many of you, if you're unaware, we've built this kind of what we term conglomerate symbol. And this symbol happens to be what we term the monsters of tech. It's Facebook, okay, plus Apple, plus Microsoft, plus Google, plus Amazon, and it's all ratioed together. And one of the aspects that you really have to focus on here is that these five underlyings, again, I just want to highlight, okay, this particular ratio, and this is a symbol that I just built into Thinkorswim, okay, to make it easier, softer, gentler world to be able to look at these five underlyings. It's not just exploded to the upside, but we're at all-time highs. Now, the previous and all-time high inside of the NASDAQ was achieved right back here, which happens to be early March. However, the monsters of tech, which again, people, is just five underlyings, has actually broken to new highs. And again, I want to show you kind of the contrast of this, because here specifically is the NASDAQ. And as I said, the NASDAQ kind of, peaked out and hit its all-time high back in mid to early March, whereas right now is when these five underlyings, the monsters of tech, have actually forged forward. People, that's where the strength lies in this marketplace. I know, a lot of people are like, oh, this rally has been absolutely, ridiculous. The rally has been unprecedented. And I have to go, whoa. Back up for just a second. First of all, let's cruise back to a 30-day 1 hour. Okay. Over the last 30 days, all right, how much higher are we? Inside of the S&Ps, the answer is not very much. We're back up to 2750, right? Just a few weeks ago, and when I say a few weeks ago, this is just sitting here on what? May 22nd, we're trading 2740, we're trading 2740, we're trading 2740 multiple times in May. If you back up a little bit more than that in terms of the time frame, we'll actually cruise out to like 2 hours over the last, we'll say 90 days. We'll hit okay. You back out a little bit further, and again, some of the rallies that we saw after the big volatility, and the big volatility coming in early February into really into March timeframe, but following some of that volatility, I mean, people, we came all the way back up to 2,800. So timeout right there. We haven't seen anything yet. All right. So the rally that is this most latest rally that's kind of ensued has really been driven almost exclusively, and this is one of the most important points to be made, almost exclusively from five underlyings. If we start looking in depth at the financials, which are arguably one of the biggest sectors out there, and really are one of the biggest sectors, in fact, they're neck and neck with the technology sector. Nevertheless, okay, there are companies that are not necessarily in the financial sector that move with the financial sector. So the financials are arguably larger than technology. Nevertheless, I wanted to show you, okay, here's the bid back in the financials, which has been relatively mute versus what you're seeing in the rest of the market. The other aspect that also begs to be looked at is we've actually got weakness inside of the energy sector specifically today. But is that enough to pull down the S&Ps? Absolutely not. However, it's clearly prohibitive to the S&Ps at this point in time. Now, one of the aspects that I've been talking about a lot over the last few weeks has actually been relative movement in the Russell, okay, versus the S&Ps. And for those of you that'll kind of recall, and I can bring back up a specific chart in here, but let's go over here to the Qs. This is the QQQ, and one of the styles that I've recently built happens to be effectively comparing the Qs versus the spiders versus the IWM. And again, I just want to take a moment and bring this to your attention, because one of the positions that we discussed was what? Well, we were looking effectively at the Russell, okay, versus the spiders. And we talked about being short the Russell, which is right here, versus long the spiders, and how the two were going to start to converge upon one another. Now, we're on a year to date, but if you start to zoom this in just a bit, all right, and to zoom it in, again, you can come over here to time frame instead of year to date. You can even come down to like 1 month. We'll turn around and hit OK. You can see exactly what I'm talking about on a percentage, again, on a percentage basis. You're now effectively seeing a little bit of weakness in the IWM, okay, versus the S&Ps. Now, what's this almost vertical line right here? Well, that almost vertical line is none other than the NASDAQ. So the trade that we've actually proposed, which was, again, short Russell, long S&P, is working. There is a bit of a convergence now going on between the Russell. And this is something, again, for those of you that are a little bit more experienced in trading, this is the kind of stuff that you really need to focus on, okay? Trading one product relative to another. I mean, people, that's kind of the final frontier for traders. And the other day in the TheoTrade chat room, we discussed a multitude of ways to be able to effectively take those trades. All right. So let's clear the slate over there for just a second. I will continue to reiterate, I still like the trade. I'm still in the trade. So I'm short Russell, long a little bit of S&Ps against that. All right, blank the slate. Let's continue to move on. One of the things that's, I think, really on my mind has a lot to do with the emerging markets. So last Wednesday on the evening video, I talked about building a bullish position inside of the emerging markets. I want to clarify this. In the bullish position in the emerging markets, we're out, and we're out profitably. That position effectively in 3 trading days exploded at the upside. It was an in-out spread. We have subsequently closed the position. Okay, people made between a 40 and 50% profit on the in-out spread inside of that very short period of time. Now, I want to be crystal clear about this. I was bullish in the emerging markets. Why were we bullish? We were looking for a bounce trade. Okay, big time out over here. That's it. If you were bullish in there, you need to get out. Why? Because this happens to be a big portion of this evening's kind of video, is that I think now we're going to see a bit of a reversal back down inside of the emerging markets. We played the bounce trade, we got out happy, but now, and specifically tomorrow, I'm going to be shopping bearish trades inside of the emerging markets. And to get a little bit more into the emerging markets, so why am I picking on them? Because I'll tell you what, okay? Over the last just, few weeks of trade, we've poked into bearish trades. We had a bullish trade, we had a bearish trade, we had another bullish trade. We're going to flip it back over. So we've been kind of playing around on both sides of this marketplace, getting a decent feel for the emerging markets. And hey, listen, just because the S&P seem a little boring, because the NASDAQ has been a one-way ticket to the upside, doesn't mean that there's not two-sided trade, doesn't mean that there's not volatility. All right, the emerging markets have all of that. Not to exclude anything in the spiders, but look at the EEM. Things doing almost 130,000 contracts, and most people don't even track it. Emerging markets, to me, right now, this is where it's at, right? All right, so with the emerging markets, why all of a sudden, after this bounce, am I reverting back to the stance that there could be another big bearish move inside of here? Well, that has to have a lot to do, okay, and almost everything to do with the fact that the dollar, okay, is reversing. So the dollar, which we've also been very, very critical about, has had an explosive move to the upside. It reverts back. This morning, it looked like the dollar was going to have follow through. It reversed, okay, and it literally reversed in the trading day. And I want to show you specifically this reversal, an intraday reversal on the trading day, where the dollar took off out of the gate and just kept going. All right, strength in the dollar. It's not going to look good for the emerging markets. Again, strength in the dollar is not going to look good for the emerging markets. The other aspect that really comes into play with the emerging markets. Let's put the dollar aside. Let's think that, maybe you don't believe the dollar is going to be strong. Maybe you believe the dollar is going to weak. But what do you believe specifically? What do you believe about the trade war? Okay, trade war, yeah, coming to a theater near you. That's not going to cool off anytime soon. And the one reality is, if you're looking at the S&Ps versus the emerging markets are not going to fare well versus the S&P 500. When it comes down to a trade war, okay, you're going to see traders, they're going to be like, oh, emerging markets are going to get killed in a trade war. At least the S&Ps could go down. But in the end, the emerging markets are going to do a lot worse inside of that war. So nevertheless, we're going to be looking for bearish positions. Again, bearish positions in the emerging markets in the day to come. What kind of positions am I going to take in emerging markets? Well, this is going to be multiple positions fold. One thing I want to do in the emerging markets to take that bearish position happens to be I'll go out, for example, about 32 days, and I may be building an in-out spread. This is exactly what we did on the bullish side of the equation. Okay, why not flip it over, okay, and do literally the exact opposite? This happens to be a $2 wide spread for about 89, 90 cent debit. Again, I'm going to reprice this tomorrow. I have not yet routed this trade. I have not yet sent off the trade. This is something I'm going to be focusing on tomorrow. So this is one of the bearish positions. This is just a short-term 32-day, yada, yada, yada. I'm in, I'm out. I'm trying to make some 55%. Now, on a longer duration, I also want to step up to the plate and possibly create what I call a duration, again, a duration bearish position. This is something I will be covering much more tomorrow in the TheoTrade chat room. So that's going to be Tuesday, June 5th. I'll cover it in the chat room, how I'm going to go about creating, why I'm going to go about creating, okay, everything you need to know about creating that bearish position inside of the emerging markets. Last but definitely not least, we're going to go back over to the XLF. The XLF, which are the financials, weak on a relative basis. The next few days, okay, everything in the marketplace in terms of this rally hinges on specifically what the financials are going to do. Remember, the financials have had everything going their direction. They've had everything from tax breaks to deregulation, okay, to they're allowed to now do stock buybacks and bonuses again. I could go on for a half an hour that everything is going right for the financials, and they still can't get out of their own way. This is something we're going to keep a very close eye on inside just the next few trades. This is the point where we make or break right now in the mid 27.5 region. With that, I want to thank everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.